job is education and enrollments and more early career or uh, and of course I get a lot of people when they're getting ready to retire and want to review that retirement planning side as well. Even on people in PERS because they know I'm familiar with PERS, so the HR people will call me or whoever and say, hey, can you meet with, he got his estimate of benefits, he doesn't understand them, can you sit down and kind of walk him through and explain how PERS works. So we do that free of charge. We provide financial and retirement planning to the employees of all our groups, whether or not they're a client or not. So I do that a good bit just because of my background. For example, they asked me to, kind of give an example of how Corbridge and having so many representatives that live in the state and work these groups and have been doing it a long time, that we understand ORP, we understand PERS, we understand the client because, we're here, we're living where they're living. And so, for an example, I was thinking, I was like, I recently, maybe in the last year, had a client or an individual at Alcorn State who was a coach. He actually reached out to me about the 403B plan, and because he had previously been at Mississippi Valley and was in the 403 there as well as ORP. And talking to him, I was like, well, why are you calling me about the 403B? Why aren't you calling me about ORP? And he's like, well, I'm in PERS. And I'm like, well, you were in ORP at Valley. And he's like, yeah, but when I came to Alcorn previously, he's like, this is my second stint at Alcorn. And when I came then, last time, they put me in PERS. And I was like, well, are you in an ORP eligible position? And he was like, well, I'm not sure. I guess I'm a coach. And I was like, well, then you should not be in PERS. And if PERS finds out, they're going to kick you out and they're going to, give you your contributions and no earnings. So I was like, we need to figure this out. So contacted HR, we contacted PERS, and they was like, yes, you were in PERS, your current position, that position was ORP eligible, this position is ORP eligible, you should not be in PERS. So we got that straightened out. We got his, luckily, only 1 year's worth of contributions, but it was over $11,000, I believe, sent back to him, as well as the employer contributions, which is important for ORP, and got him in the correct account so he wouldn't continue to be putting money into PERS that was not going to have gains for him, not going to be invested for him, because the day he tried to retire from PERS, PERS was going to find out he shouldn't be there, and they were going to, tell him no. So I think that was an example, and he was very appreciative of that. The group, Alcorn State, was very appreciative that we caught that. And I think that's an example of just having the knowledge and the background of understanding the system. If you're just calling a 1-800 number somewhere in another state, then they're not going to understand. They're not going to be looking at backgrounds. They're going to be looking at the accounts you're calling about. They're not going to take a more holistic approach and try to, look at your whole situation. So I just think that was an example of how this team, not just me, but anybody, all of our local reps have a good understanding of the plan and how it works. So just wanted to share that and say that I've really enjoyed. We're just now getting back on site at UMC. We've actually just in the last month have been allowed back on campus to meet with employees and clients since COVID. So I think that's going to have help us a lot, being able to engage more with our clients and do more reviews and retirement plannings, getting an easier face-to-face interaction because as Mr. Rutledge knows over there, sometimes, it's hard for them to, if they want an in-person meeting and they have to come to our offices, which we do have local office in Ridgeland. Sometimes it's kind of hard with their schedule. So being able to go on site is going to be huge with helping to drive that in-person engagement with the clients there. So I just wanted to say I'm glad to be back here, seeing you people, and I'm happy that I'm getting to continue to work in some small way with PERS in this position as well. So, thank you.
Thank you. So I'll quickly wrap up on slide 24. I know you guys have an investment consultant, and they are covering the review of the investments and the overall allocation across vendors. But in our plan on slide 24, we have a really great story because you're defaulting enrollments into target date fund. It allows people to be properly diversified and not have to make that overwhelming decision of investments. We have close to 41% of the participants in the plan in a target date fund. And that, of course, is based on their age and when they will be projected to retire. The other 34% is well diversified with 5 or more investments. My guess is part of that is that enrollment in that professionally managed account, because we're going to also make sure that you're properly diversified with your age and your retirement goals. And then lastly, jumping way ahead, because most of this is investment information that you will learn in our meeting, I'll just go to 44. And this is a typical marketing, communication, and engagement calendar that we are working towards. So as you can see, every single month we're pushing out campaigns that are coordinated both through digital, on the web, email, if it's been provided to us by the participant, and then of course the advisor receiving that same calendar on site. And so each month you can see that it's nudging people towards importance of savings. We honored National Financial Capability Month in April. We observe National Retirement Planning Month in October, and constantly pushing out new messaging to individuals. The other point I'll bring up is our digital engagement is intuitive. So if someone let's say saving enough, then we're going to push out a diversification email to them. And so we're not going to, we understand what they're doing on our system, and then we're sending them the right messages at the right time and saving together. We're also not going to send a 75-year-old a retiree checklist, right? We want to send them one at the right age, maybe. So good scraping of information to send out the right message at the right time. So that's our formal presentation. I'm happy to answer any questions that you guys may have.
Going back to slide 13, the thank you for your presentation and remarks, and good to see several of you again. The 1270 over toward the right of active participants, you said that is someone who had contribution within the last period, and the period meaning the last fiscal year. Is that right?
The last 12 months, yeah, so 12 rolling months.
So it'd be from, all right, well, that says June 30th, but technically it'd be.
Right.
And then at the bottom, the 340 of the guided portfolio services, do you have any insight as to what stage of career most of those individuals are? Like, are they early stage, late stage?
We do. So let me find the page. I'm sorry, I skipped by it. It's broken out by age band. And so it's interesting. So 39. Yep, slide 39. Give me a minute.
Okay.
So if you look at the way to read this is at the top, you've got your age bands, uh, percent of total assets, and then what the average assets are in the account in that first bucket. And then it looks like it's at the bottom, years until retirement. So I did find it interesting. I actually calculated how much the participants were spending. So if you look at that 20 to 29-year range with 46 participants, average assets are pretty low at 23,000. That's costing them $93 a year because it's 40 basis points, right, Jane? 40 basis points charge. So pretty inexpensive to have your account professionally managed. But of course, as your assets grow, the charge is based on percentage of assets. So the majority of the assets, as you would expect, is in these younger years because I think the services really have benefited you as you were getting close to retirement.
Mr. Chairman, if I could mention something, we're having a few technical difficulties. I'm not aware of all the exact details a little bit, but if it'd be agreeable, we could take a short break in between these presenters and maybe work on that. Mic check. Mic check.
Mr. Chairman, we have next TIAA, our second vendor of the optional retirement plan for institutions of higher learning. And here today we have Mr. Tim O'Donnell, who is our market leader for TIA. We have Mr. Austin Morris, who is a relationship manager. Ms. Shirley Yang is a senior investment strategist. And while not a speaker, they also brought Rosalind Banks, who is a financial consultant in the field here in Mississippi for TIA. So with that being said, I'll turn it over to Tim.
Thank you, Davetta. Appreciate it. Good morning. It's a pleasure to be here. And as Davetta mentioned, my name is Tim O'Donnell. I'm the managing director at TIAA out of our Atlanta office, and I'm the market leader for the Southeast. So I have overall responsibility for all of our client To my immediate left is Austin Morris. He's a relationship manager, relatively new to the team. He joined as the relationship manager this past June. And of course, Austin will introduce himself, but he has extensive experience with public plans and has also been a wealth management advisor at TIAA. So he's worked both on the institutional side of the house and the individual side of the house. To my immediate right is Shirley Yang. Shirley is the investment strategist and will be discussing today the most recent performance of the program. And then, as Yvette also mentioned, Ross Banks is a financial consultant based in Memphis and engages with your participants. So Austin will provide an overview and really focus on trends, whether it be assets, contributions, participants, and illustrate to you the changes over the past year since late 2023 through today, or most recently. And Austin will also touch on some of the communications and engagement that we have been involved in over the past year. Give you a feel for what we've done from a marketing and a communication standpoint, in addition to the engagement that Roz has with your participants. So I really just wanted to introduce the team and primarily say thank you on behalf of TIAA. Um, we have partnered with you since 1990, and we very much appreciate the trust that you put into TIAA to work with you all, and most importantly, the employees of the state of Mississippi. So thank you very much. And with that, I'll hand it off to Austin.
Thanks, Tim. Good morning, everyone. Great to be back in Jackson. Was here late June and a little bit cooler today, so I'm excited about that. As Tim mentioned, I'm Austin Morris. I'm the relationship manager that works closely with Nevada, Charleston, on the rest of the ORP team, and excited to provide some highlights around the TIA plan. Tim mentioned I've been newer to Mississippi and the team here in Mississippi, but not new to the business. Been at TIA 11 years. First 6 years was spent on the wealth management side, working with high net worth individuals, and then to make a broader impact with participants across various states that I work with. So again, excited to be here. We can jump right in. If you look at the second page of the booklets that you all should have, is really just a highlight of today's discussion. I'm going to go over the executive summary overview, certainly highlight some of the plan trends, and certainly talk about communication. If you flip to page 4, we'll start just with the executive summary and overview. There's a couple of call outs and trends that we want to really look at. One is just target date. Right? So target date funds continue to gain the majority of contributions. If you look to the chart to the right, you can see the investment by age group. Not surprising, this is a trend we see across our institutional business. Majority of folks invested in those funds are what we would classify as early career, that are not proactively making an investment election, defaulting into the plan default, which for you all is the Nuveen life cycle. We'll spend some more time talking about that. But they also, those funds across all demographics receive 54% of the contribution. And those, it's a trend that's growing every year. Again, not unlike our institutional book at TIAA. The second really important call out, plan participants are really looking to receive education on how to invest their savings now more than ever. We've seen digital engagement increase significantly. We've seen year-over-year education and advice meetings increase, and online engagement is increasing at a rapid pace. The last thing is participants continue to show interest for those that are wanting help in investing their money, and we see the number of individuals with an in-plan managed account solution has remained steady. Look to the next page, just a quick review of the Mississippi ORP team. As Tim introduced himself, he works alongside Jim Mullery, who's head of our institutional client management, all of TIAA. And then the direct service team, myself, really kind of quarterbacking the team here at TIAA. Listed Demansky handles the communication side of things for all the ORP participants. Shirley, again, to my right, the senior investment strategist. She'll get into a little bit of her role in a second. And then Ellis Jefferson handles the client service management, working closely with Devetta, Charleston, on plan maintenance and service. Underneath that immediate team is kind of the extended team that really works collaboratively and collectively across the state at all of the member institutions in ORP to provide education advice to Rob certainly is one of those with boots on the ground, working with the majority of the universities in Mississippi. If we get into some of the plan reviews and highlights on page 7, just a quick review of the ORP asset review and the plan summary as of 6/30/2024. Start down at the bottom on the left. You can see starting in June 2018, assets continue to increase. As of 6/30/2024, just over $1 billion in assets in ORP, with PIA being record kept. And then a couple of call outs on the right side. One, total contribution, so a little over 56 million went in. We'll get into the breakdown between employer and employee. You can see the total distributions of around just over 43 million total assets and a little over 5,200 total participants with the IAA. The other two numbers you see there are a breakdown between the legacy fund lineup contract and the current lineup group contract, institutionally owned. ORP balances have increased 17% year over year. And the last call out is TI's annual administrative cost, $75 per individual participant within the ORP. I believe that is the lowest of the 3 vendors. Get into the next page, just looking at ORP plan investment allocation. You can just see this is the fund line, the current institutional group contract. In alphabetical order there, you can see the asset classes, the balance. If you take a look there, you can see that equities currently take up just under 43% of total allocation. And then in second, there's those multi-asset that would be classified by those target date funds that we mentioned in the executive summary. One item of note is the Nuveen Lifecycle Fund that you see listed here. This is as of 6/30. Those did change July 17th, 2024 to the Collective Investment Trust, the lower cost option that helps participants across the state save money in the default. Surely we'll talk a little bit more about that in a second, but I want to acknowledge the good work that Charles and the team did around implementing that to save participants in Mississippi on the internal expenses of those default investments. And then there's also a 0 R4 plan service expense share class available in the pref options that you see in the upper right hand side of that we look forward to potentially bringing to the ORP in 2025 to help participants with some additional cost savings on those. Go to the next page, which looks at assets by universities. You all know this in your roles, but we I call it the big four institutions in the state. Certainly have the majority of the assets. Look in the middle, Mississippi State, followed by University of Mississippi, UMMC, and University of Southern Mississippi. The other member institutions and institutions of higher education spread and trail those assets. From a contribution standpoint, as I mentioned, just over 56 million in. You can see the breakdown: employee contributions just over 21 million, and the employer contribution just under 35 million. To the right in that chart, you can see the contribution based on the higher education institutions across the state, and then the number of employees that are actively contributing within those institutions. Active contributions are anyone that's made a contribution within the previous 12 months. If we look at contribution history, again, just going back to 6/30/2018 on the fiscal year side, see the trend where those contributions continue to go up across the board on all 3 phases: employee, employer, and total. As of last year, again, just over 56 million went in, and you can see the breakdown of employee and employer contributions. Contributions are up for participants, and employers are up both 5% year over year. Trend to look at there. We look at contributions by asset class. Again, going to be in alphabetical order. You can see the asset class color coded there. Call out here, as I mentioned in the executive summary, if you look at that multi-asset, those are going to be in this report, the Nuveen Lifecycle target date funds continue to gain traction. You can see they're getting the overwhelming majority of those contributions. Just a critical component of the due diligence that the ORP and PERS team has done in reviewing those and making sure they're providing best-in-class options for participants across the state. So thank you to the team there. I'll pause here and see if there's any questions
employees are choosing multiple accounts? Because we're getting two different answers. We asked for ORP participants.
So one of that could be explained by, in a very isolated circumstances, participants are contributing to multiple employer plans. I think the larger trend that we see there is that 2379 is the active participant, but there are folks that have separated from service, they've retired or left the Mississippi system, and they choose to leave those balances in the plan. So total participants are what I referenced in that total number of 5208. When we look at active, we get that 2,379.
So the 2,379 will be current Mississippi State
Currently contributing that have made a contribution to the previous 12 months.
You've added 336 per page 4.
Correct.
And about 88% of your total monies come from Southern, Ole Miss, Mississippi State, and the Mountain.
Correct.
And 21 million was the employee contribution. The state matched that at 35. Correct.
Yes, sir.
$75 cost per person. Doesn't matter if I have accounts with you. Is that per account or actually per person?
Per participant at TIA. So if you've got multiple accounts, let's say you worked at Mississippi State and you switch over to Ole Miss, it's at $75 per head per participant. Doesn't matter if you have multiple employers or multiple contracts within the system.
So each dollar I would have if I worked at multiple state entities that allowed ORP would be a separate participant, a separate account.
It could be a separate contract underneath the plan, but you would still be listed as full participant. I think that's where there's a small subset of folks that maybe are contributing to more than one institution, very isolated cases, in my opinion. But if you're in the ORP, regardless of where the contributions are going, you're at $75 per that unique participant.
Thank you.
Thank you. So just getting back to the contributions via asset class, again, the call out there, the target date continue to get the majority of contributions. We look at balances by the universities. To your point, sir, the majority of assets and participants are coming from those the largest institutions across the state. You can see the chart to the left there that shows the participants at those institutions. And then again, to your point, sir, can't have balances at multiple universities. Oh, sorry. Page 13 is where I am. So again, just calling out those participants by balance. And then we also show on page 13 those inactive. So that equals up to that total of a little over 5,600. There's 2,829 participants that have not made a contribution within the previous 12 months. Majority of those, I would imagine, are separated from service, retired, have moved over to other roles. We look at page 14, just to highlight the enrollment trends. Again, this is June 30th, 2024. You can look down the list to the left, see the number of enrollments, 336 as the fiscal year. We look at the enrollment history going back to 2018. Dipped there in 2020 during the pandemic, but you can see that overall the trend is that enrollment continue to increase at TIA from a record keeping standpoint. So participants are choosing TIA, putting their faith in us to help them manage their retirement assets within the OR. Page 15 just shows closed accounts. So we mentioned there are some folks that choose to leave the Mississippi ORP, transfer their assets and balances to either retail investment products or employer plans, and this just highlights per institution the number of closed accounts via the last fiscal year as of 2024 across the state in those higher education institutions. Next page looks at investment allocations by participant age group. This just builds out a little bit of what we talked about on the executive summary. So you can see the color codes there at the top of the chart. My eyes are drawn to the large blue, darker blue, swath of charts that really represent the multi-asset asset class target date funds. So you can see again a heavy bias those early career participants for target date fund. Reasons for that, but 75%, 72+% in that age range of 30 to 39. I would call 40 to 49 mid-career. 43% starts to trail off, and then as we get into later career, you can see that there's more diversification of folks that are taking a little bit more of a proactive role in their investment and their allocations. You look at 17, just participants in each investment option. This just gives you the breakdown to show the number of actual individuals that are taking advantage of the various investments that are on the active menu. And you can see again the large numbers that fall in that multi-asset category, just really driving home the trends that we see across the state for Mississippi ORP, but also a lot of other ORPs and state systems that we work with, similar trends with folks gravitating towards the default that's on the menu. Any questions? Take a quick pause.
Again, I'm not understanding participants versus enrollment. Now your 5208 says number of participants, but you're showing me investment options used. But when we go back to page 17, if I tallied up the participants column, it's into the thousands.
Yeah, so again, there's participants that can use multiple investment options. So let's say I have a portfolio in Mississippi State ORP plan. I may have a diversified portfolio with 6 different investments, but I'm one participant, as opposed to someone that may just be in a single investment in one of those multi-asset target date funds.
And I can appreciate that, but I just want to make sure that there was legislation last year, and liables will be legislation again. We need to know how many participants from institutions that are participating in this program, which I'm assuming the 8 that are listed or 9, whatever your category is. And I'm not, it's not just for y'all, this is for every
Sure.
ORP, and I apologize for being a little tardy today. But I want to make sure I understand what an enrolled person in Mississippi looks like, because only certain people are eligible to participate in ORP.
Yep.
And if I diversify into 6 or 8 different accounts, that's none of my business. I get that. But we do need to know the number of people enrolled, as well as, I'm assuming, the closed accounts. You could break that down by active or inactive.
Yeah, so closed accounts would largely be inactive
Okay.
participants that have not made a contribution in the previous 12 months.
Okay. All right, thank you.
Yep. All right. If we look at the next page on page 18, this is just participants by age group and average balance. So again, as to be expected, larger balances for more tenure, longer career individuals within the ORP. The green represents those average balances, and then the blue represents the number of participants within those age ranges. And then on page 19, just looking at the investment options utilized. To your point, sir, if we look at the very first column of just one investment utilized, there's 2,718 individuals. Those largely, in my opinion, would be folks that are in the target date funds, right? And then as you get into those larger numbers, those are folks that have chosen to say, hey, I want to have a very diversified portfolio. On an extreme end, you see 27 investment used by one individual, right? So really spreading things out there in terms of allocation, but average number of investment options utilized per participant is 3.3633. Okay, so on average, folks are holding just under 4 different options in their particular individual account. Page 20, we won't spend a lot of time here, but just this is more so for the legacy contracts of just showing and highlighting folks that are taking advantage of the lifetime income that some of those legacy investments could provide. So there's 146 folks across the state that are actively currently receiving some form of lifetime income. We switch to 23. If we skip ahead a little bit, we'll talk a little bit about the engaging your participants and some of the things we've done across the state. So on 23, what we're highlighting here is advice and counseling meetings that are assisted. These are individuals that have proactively said, hey, I want to meet with a TIA financial consultant or a TIA wealth management advisor. Financial consultants really advise on in-plan assets and help with asset allocation, risk, things of that nature. And wealth management advisors kind of take the next step and will provide a holistic financial plan, all inclusive of the $75 per participant cost at TIAA. So no additional fees or charges for these services. But just looking at the 2023 trends, that was a full year. You can see the number of meetings between financial consultants and advisors. If we look at 2024, this is year to date through August, we've seen similar trends in terms of the meetings, number of meetings, percentages between financial consultants and advisors. And I'll just take a second to shout out Rosalind and her efforts across the state in really engaging with participants and making sure that they're retirement ready based on their needs. So what are participants saying on page 24 of those that engage with us, take advantage of those additional services of advice? We look at the 2023 surveys. That was a full year. We had 35 respondents. You can see there's 3 areas we measure. One's understanding your needs and goals. One is, do they feel the representative they met with had the expertise required to help them? And the last metric we look at is, did that individual put my interest first as an ORP participant? So very proud of these numbers. Again, speaks to the good work that our financial consultants and advisors are doing across the state. And then 2024, so far, we've had 18 surveys responded, and you can see 96% feel we understand their goals, and 100% feel we have the expertise required and put their participants' interests first. So proud of those numbers. Page 26, just looking at the 2024 program results, there were 2,749 participants reached from a communication standpoint. 2.44% have signed up for e-delivery. 3.46% have reallocated or rebalanced. Just under 4% have updated beneficiaries. That's something that we always want to keep a close eye on, making sure that those assets pass to the intended individuals in the ORP. On page 27, just highlighting one of the things we called out in the executive summary is participants are engaging digitally and virtually. We expect that trend to certainly continue. A couple of points I'll call out, which I think is very strong from some of the other states we work with. 88% of ORP participants have a valid email address, so we're able to communicate with them and get updates and notices around their ORP account. 69% of participants had at least one web login in the last fiscal year. So strong trends there, and 90% of participants have taken the initiative to establish a web ID, be able to track and engage with us on our TIA website to engage with their retirement plan, which is what we all want. Page 28, again, just some other engagement numbers that we call out. We know through looking at trends that participants that engage with us digitally and take a proactive role in their retirement plans tend to have better outcomes versus folks that are just unengaged. So 26% higher balances of digitally engaged Mississippi ORP participants. And you can see the chart there to the right. Green is going to be digital unengaged, and then the blue is going to be digital engaged, which just leads to higher balances, more engagement, and proactive attention and care to their retirement accounts. The next several pages highlight just some of the communications campaigns that I mentioned. Alyssa is a valuable member of the team. We run monthly campaigns to engage with ORP participants, various topics, financial foundations, asset allocations. You name it, mid-year check-ins. Really, again, the goal is to encourage active participation and engagement among Mississippi ORP participants. As I mentioned, that engagement leads to certainly better outcomes and retirement readiness. So I'll pause here before I turn it over to Shirley for a couple of comments, but want to answer any questions the board or committee may have.
Austin, so you've got, make sure I'm clear on this, 2,379 active participants. mandated to do ORP and they choose TIA to do that. And then you got 2,829 inactives. Is that 225 that closed their accounts included in that 2,829?
And I think the 225 would be excluded from that.
Okay.
So what we would classify as inactive are folks that are no longer making contributions or have not made a contribution the previous 12 months, but they still maintain their balances within the ORP.
So it seems like you'd be in one or the other, just making sure that was. And so out of that 2,829 and 2,379, how many of those, if they're not all unique as far as people go, and am I hearing that they aren't? Maybe there's a small amount in there that may not be unique, or is there a large amount in there that may not be unique?
I would say there's a very small amount of participants that can have balances at multiple higher education institutions within the ORP. So
there may be some duplication when you take all three vendors together.
Correct.
Okay.
And to your point, there's also folks that
Use multiple.
use multiple vendors, right? So I could say, hey, I want to do 50% of my contribution to TIAA, 50% to Corebridge or Voya, right? So that's another thing that we see is there are TI participants that also contribute within the ORP with another vendor.
And has there been some verification, Ray, on that being true?
I would say it's in the process. First, let me say, I apologize. I've been a little bit focused on some of the technical difficulties as the discussion has ensued, but on that, that's in process. Ms. Lee has done a great deal of research. It's an ongoing project. As the Senator alluded to, there's some interest in ORP from our legislation last year that we'll probably be bringing forward again or some version of it. And there's been some interest on verifying and quantifying the numbers of ORP, and which we're happy to do and we'll be able to do. I think any differences between what we've presented or what may be coming from IHL probably has to do with either timing or the way the question's asked. And y'all have talked through some of that as far as the definition of an active participant and so forth. So I know that's a little bit more than what you asked for. The question, going back to your original question, it's a work in progress that I'm sure we'll be able to complete soon, and we've done a lot of work on that. But I wanted to expand on it a little bit more just so the full board and committee would be aware of kind of the project behind the scenes. And be happy to have Devetta talk more to that now, or my thought would be after we finish this week's meetings, we'll be able to summarize that on a one-page sheet or something and reconcile that.
I mean, I think it is important to verify that it is immaterial relatively, I think, from what.
And Mr. Chairman, I think, and I appreciate you asking that follow-up, because it is immaterial how many people most likely with this vendor or the other two vendors happen to have multiple accounts from different institutions. That's not my concern. My concern is when we talk about participants, enrollees, and that's a lot of clarification because an active participant is somebody who's working, making contributions, but more importantly to this board, in my opinion, is the contribution the state makes. So that's why I want to know how many enrollees we have. And in all fairness to PERS, I don't think at PERS have that data. That belongs to the institutions for which they're signed up for ORP because they are not PERS employees in that traditional sense. So that's why it may be outside of your scope. It may be outside of your ability. I think it's outside of PERS ability, but I just want to make sure for the board's sake that if we're asking how many people are in ORP, that it's not going to be able to be answered traditionally by the PERS board or the vendor. It sounds like it'll only be answered by the institution, but we're going to have to work together because if I'm using all three vendors, that's skewing the number. That's more likely than I've got two accounts with two institutions, which I could be an ORP for. So that's my ultimate question is how many employees in the state of Mississippi are in ORP, no matter if they're using one vendor or two or three.
Right, half of those people, 2,379, are doing 50-50.
That's yes, and
that's a big deal.
Right.
And if somebody's going to take that without an asterisk beside it that says, this is a unique count or it is not a unique count for informational purposes.
And the inactive people, are most likely not of concern as it relates to contributions because they're not making them, therefore the state is not making any. So that's just managing your money.
If I could just, oh, Mr. Chairman, go, I'll pause. He called my name, that's why.
Yeah, go ahead.
So
Go ahead.
I'll tell you, we've been digging into this and working with some of the universities as well as the vendors. Austin was very prepared for that question because I told him that was likely going to come up today. One of the things, there's two things. You could be in, let's just say the methodology for PERS's numbers that we've been reporting in the facts and figures for many years is based on the information we receive from the vendors. Right, from these reports that you are receiving today is where that information is compiled. And it's known that there are a couple of caveats. These are active accounts, number of active accounts with Voya, TIA, or Corebridge. When you're hired and you select ORP, you may choose who your vendor would be. And we have some old accounts, especially when this was an asset-based fee, they may have just said a third, a third, a third. We're going back to 1990 when these were insurance companies selling annuities. So diversification might have been half at Voya and half at TIA. The world has changed. The plan has changed. As he mentioned, we're now a per head fee. You all remember that exercise several years ago. Now it's better for you to just choose one and pay that one fee instead of paying TIA, Voya, or VALIC, an additional per head fee. So the world has changed. They have open, we can put whatever mutual funds we want to put in their plans. It's not just insurance annuities like it may have been long ago. ORP has evolved over the last 35 years. And so there's some older accounts, especially, that may have chosen more diversification with multiple vendors. So that's one of the concerns. Another concern, and speaking to some of the universities, as Austin said clearly, the way we say an active account means they made a contribution to ORP in the 12-month fiscal year. Well, as you know, ORP is designed for portability. The whole purpose of ORP is people can come and go. They can take their money with them. They're immediately vested. It's a come and go plan. If I work at your university and I'm hired through July, right? And then a new professor comes in, I move to another university, a new professor comes in August for the school year, they would both have contributed one job, but both have contributed in that fiscal year. So I can be transparent about the methodology of how we collect the data, and that may differ from us, and we do get information from the universities, but if that's a fixed date, how many people you have today versus what we've been reporting is how many people were contributing in the plan over the fiscal year. So there's several things we can, as Mr. Higgins said, we're working on a one-pager that we can share with Senator Sparks and other leadership, share with you as a board, just to make sure that you all understand what we're reporting. But do know this number is going to change because you're constantly having transition and portability. They may be there through the fall semester, but then a new professor comes in the spring semester. That will be reported as two employees paying in the fiscal year. Does that make sense? So we're working with Senator Sparks and other leaders to make sure that we are all saying the same thing and that the methodology of what we're reporting versus what they may get from universities is all explained.
So universities do not have a specified number of employees. The universities then can expand or contract their employees and not go through the state personnel board with a, what's that thing called, a PIN number?
Well, no, so they're not under the state personnel
They're not under
board,
SPB.
so-
Okay, so we can't tie a position to two employees and they're both in the ORP and eliminate it and just make it one. That's what I'm hearing.
We can, and that's what we're going to work. We're just going to have to all agree on what number we want. And so that number may be Senator Sparks may say, I want the number on June 30 of official ORP accounts that are active at that moment and the employee contributions that were paid and employer contributions paid on June 30. Or we may say, this is college, this is summer, summer's transitional, we might not want June, right? We may want a different date because they may have terminated at the end of the school year. So those are the things that make ORP just a little bit more nuanced and more complicated.
Well, that's very much like in schools when you start talking how many students are actually there. You have to pick a day and just
Stick with it.
that day. And
Right.
that's about as good as we can get because there's so many people transitioning in and out to get a true enrollment.
Right.
So that sounds reasonable to me, that we just need to pick a day and say, we can make it official. We can tell you exactly the day, but over a 2-month period,
Right.
you know, it's gonna be hard.
So maybe March 30th may be a better day for universities
I
than
don't know
summer.
what'd be a good day for the university. I just know that with comings and goings, generally, you just have to take a snapshot and hopefully it's, over time, it's the most representative of the number that you're trying to get to.
Well,
And-
again, it's
yeah.
just qualification of
That's
the
right.
number and transparency of what it is. And back to Senator Sparks's comment about, it's really about the contributions. If you're going to calculate something, the contributions are what's more definite.
As I can go ahead and tell you,
And a better number.
the next question is, when you identify employees, you need to know what the average compensation is, because then you can actually do a math function that matters. But at $75 a head, and it's not a shout out to this particular vendor, but at that amount of money, I may choose more than one vendor. That's not a barrier.
Absolutely. And
Yeah.
when it was an asset-based fee, it was a bit, I mean, it made more, well, I'm going to pay a percentage of my assets anyway, so it doesn't matter if it's split across 3. When we went to per head, which a heavy load for leadership here at PERS to do that, it's $75 doesn't sound that much when you have maybe $300,000 in the account. So that's the participation fee. And some of them said, I don't care. I still like Voya and I still like TIA, so I'll pay for both. And that's their responsibility to do. That was, the law says that PERS shall have 3 to 5 vendors. And so that's been since, I think, 1990 or so. So it's been in the law that way, and the people have the right to choose which one they pick. So you're right, $75 is not that big of a hindrance on these accounts.
The institutions ultimately can tell us who's in ORP.
Yes.
They probably should pick June 30 to dovetail into any reports that we see from the people that manage the money. But that's not a complex question, because you have to qualify to be an ORP. It's not a willy-nilly process.
But in trying to reconcile some of the numbers that we've heard versus some of the numbers that I've gotten directly from universities, that's what called to question maybe summer is not the most ideal time for an educational institution to report, because the number that I got as of last week was significantly higher at some of our larger institutions than a number that was reported based on June. So those are all, we're thinking through methodology, best data, best way to give it to you, best way to be as transparent as possible. So maybe we do both. Maybe we do a March 30th and a June 30th. Just coming up with ways to be as honest, as we can, because, during the summer, maybe you don't have as many people on payroll as you do in the spring or fall. So those are just some of the things we're thinking through and trying to be as transparent as possible.
Thank you
Mr.
for
Chairman,
that.
thank you.
I think that was timely. So sorry for the diversion. So thank you.
No
Please
problem.
continue.
Tim, did you have something?
No, I think it's time for Shirley to make a few comments.
Okay.
Yeah.
Shirley, you want to
Yeah,
pick up on the investments?
On the investments, I'm just going to make my remarks very brief and highlight accomplishments for this year. And so Austin
And you
mentioned.
sorry, Shirley, you may want to move that microphone pointed that way a little bit where it's.
Yep. So Austin did mention an enhancement that was made to the ORP with respect to the life cycle funds. And I just want to make a special shout out to the PERS team for leading an enhancement which moved the target date funds within the plan from a mutual fund vehicle to the CITs, or the collective investment trust, effectively reducing the asset-based fee by 20%, translates into about $275,000 annually to those participants who are in the target date fund. So again, it was a great effort and initiative led by PERS, DeVetta, Centron, Charles, Nielsen. Just want to, again, special shout out. That is our role here, is to partner and to make sure that we can offer the latest investments and enhancements that do benefit the participants. So if there are any questions, that's really all I wanted to say about the investments and the performance, because also, as Austin mentioned, there's about 20% of assets in these life cycle funds, target date funds, and over half of contributions are going into these funds. So it's really important that we keep those at the lowest cost possible.
Questions? Okay. Well, thank you. That's all we have prepared. I want to thank the board for the time this morning and look forward to the next one.
Thank you all very much.
Thank you all very much.
Okay, that's the downside.
Mr. Chairman, our final presenter of the morning is Voya. And we have with us here Ms. Tennille Greenlee, who is the Regional Vice President for Voya, Sally O'Quinn, you've seen her every year since long before I came to PERS, here with Voya. And then is Mr. Larry Wilson, who is an investment advisor representative on the ground with our universities. David Linney is their Senior Vice President who could not make it for personal family obligations today, but he sends his best regards. And with that, I'll turn it over to Tennille.
Thank you so much for having us. We're excited to be here today and provide you guys just a little bit of an update about Voya. As Yvette mentioned, my name is Tennille Greenlee. I'm here with Sally and Larry as well. With that, I'm going to actually hand it over to Sally just a little bit to do some introductions.
Thank you, Tennille. I'm Sally. I have been here many years meeting with you. It's a pleasure to always be here. I have been with Voya for 24 years, coming on 24 years, so I've been working with your members for a very long time. Tennille has been with us for 19 years, same thing, working with your members for a very long time. And Larry coming up on 19 years. So we are very familiar. We are very proud on our page 3 with our advisors to have the same advisors, the great tenure that we do have, to be on the same universities over and over, and which makes it very easy for me, my role, to work with the HR departments and then with our advisors to make sure that everybody has all the tools that they need. And I'm going to turn that back over to Tennille.
Thanks so much, Sally. So I thought we would just jump into some of the numbers just to kind of give you guys an idea about where the employees that are in the Voya optional retirement plan are. As you can see, the numbers right now on page 5 with the total plan assets has increased exponentially. So we're sitting at almost $565 million in assets in the ORP. As we continue to page 6, it just kind of gives you a quick plan summary. You can see contributions, transfers into the plan, interest, gains and loss, and then the distributions, and then with that ending value as of June 30th of 24. Continuing on to page 7, we do have just a breakdown of the average account balance by age group. So this is a lot what you would typically expect, as people continue to progress in work for their employers, your balances are typically going to increase as a person ages. Continuing on to page 8, we do have just a breakdown of the contributing participants by age group. It is always good to see, young individuals participating in plans, taking an initiative, taking the time to sit down with their advisors to understand what's going to be in their particular best interest and how to proceed with that, which you then further see on page 9 with the diversification. So we can see that the individuals that are participating in the optional retirement plan are very well diversified. There's a full breakdown across all the different asset classes, and that really is a testament to having the local advisor that's here, available to meet with them locally and provide that additional education and resources, which is further seen on page 10, where we can see the average number of investments per individual participant in the plan as of June 2024 is 5.1. The benchmark for the universe of educational plans is 3.7. So you can definitely see having that local guidance, having the education and the resources to help all of your employees is providing that additional diversification, which ultimately leads, to further growth in their retirement plans. With that, I thought we would kind of change gears a little bit now that we've talked about the numbers and talk a little bit more about what we offer from a local perspective, that help, that guidance, that education that our advisors are providing, which is why I brought Larry in, just to kind of give you a little bit of an idea of the life of him as an advisor working individually with your employees.
Good morning. Thank you for having me. As she said, my name is Larry Wilson, and I've been an investment advisor with Voya Financial Advisors since 2008. So going on 17 years and going on my 18th year. I actually have a ORP meeting when I leave here today. So I'm going to meet with one of the professors that was hired at one of our universities here. And that encompasses a lot of what we do. So whether they're professors, whether they're coaches, whether they are administrative, establishing that relationship with that new hire and giving them all of the education that they need to make the best decision for themselves, their future, and their family. That's the crux of what we do, of what I do. The changes that was made back in 2020, a lot of the conversation starts with education, because now that ORP participant has the option to self-enroll, or the traditional route is the advisor helping them with that enrollment. We always have helped the new employee with their allocation, with their enrollment. But now with those changes, I have to make sure that the employee understands that, yes, I can still perform that role that I always have, but you now have that option to enroll yourself. And with the nature of, robo-advisors and some folks just being more comfortable with doing it with themselves, or some folks having a relationship with an advisor before they come here, some hires take that route. But for the most part, people do still want the advisor to hold their hand through that process. So that's what we do. That's what I do. I'm licensed in a number of states, partly because when the employee leaves the institution, a lot of times they're leaving Mississippi, but the relationship doesn't end. So I actually just submitted a license request for Kentucky earlier this week, I think North Carolina last week. And these are all former ORP participants who have moved on, but the relationship with the advisor is still there.
Thank you so much, Larry.
Mm-hmm.
But as you can see, just having that local guidance is huge. You can see on page 12, we did provide some additional information just on some of the stuff that our advisors across the state have provided to the employees in the PERS and optional retirement plan. We do have 7 dedicated local advisors, had over 4,600 in-person or remote meetings with individuals, and over 8,500 plus participant calls to not only our advisors, but also a support team as well. One of the big things I always like to kind of mention when we're talking about education and resources is we have it on-site support, but in addition to that, we have 24/7 access to live videos that are available as well. So both live and in-demand videos. So we do have that available as well through our financial wellness library that's available. It covers a variety of different topics, whether it may be asset allocation, investment portfolio review, it could be rebalancing, it could be talking about benefit comparisons, it can be retirement income planning. There's so many different topics out there, budgeting, etc., that I just wanted to mention that we have that capability and we have that available to all of your employees. Continuing on to page 13, this kind of shows you that we're trying to stay with the times, right? And we're trying to provide as many resources to your employees as we can. And by doing that, we also offer an easier way to be able to schedule an appointment with the local advisor. So we do offer an online scheduling tool through TimeTap, that a person can just go online, they can set up an appointment with that local representative and meet with them. And that can be both in person or virtually. Continuing on to page 14, this just kind of hits on some of the different seminar topics that we cover. This is by no means a complete list, but it does kind of give you guys an idea of some of the education and the financial wellness that we provide to your employees. Again, we've got the on-demand stuff that's available online, but we also go out and meet with folks individually in person and do seminars as well at the local universities. Continuing to page 15, this just talks about how we partner with PERS and some of the different support that we provide. We have our management support that we're constantly in touch with, providing IRS and legislative updates to all of the HR and benefit directors. We continue to do a lot of record keeping. I know we provide regular reporting, event attendance. We do try to make sure that we make it out to all the different benefit fairs, the educational meetings, and we really want to partner with you guys to be able to provide those resources. The biggest thing that I think is you probably heard me stress a lot is our local on-site support, being available to help with those day-to-day questions that come up and provide that support to your members. Continuing on, just talking about some of the different innovation and the enhancements and the tools and resources that we provide to all of your members. Page 17 really just kind of shows you at a quick snapshot some of the tools that are available. One of the biggest ones that we did roll out at the beginning of this year is our new dashboard. And what's really nice about that dashboard is it's very interactive. Not only can they see, their individual accounts that they have at Voya, but they have the ability to go in and integrate it with other accounts that they have. So if they also happen to have a TIA account, if they also happen to have a Corebridge account, they can integrate that all into their dashboard and see it all at one location, which is a really nice added feature that we have available to them. In addition to that, it does have a lot of reporting tools. It has spending analysis. So if they incorporate, say, their bank accounts or their credit cards, they can actually see all of that accumulated as well. And it's got a lot of different budgeting software in it. In addition to our new dashboard, we do send out what we call journeys, or educational campaigns that are interactive, that provide additional resources. We have our My Orange Money tool, which I know we've had for a few years, but it's nice because it's really interactive. It kind of shows them a breakdown of a lot of different topics, whether it's Social Security, their retirement, the impact of taking a loan. If they are a caregiver of an individual with special needs, for example, or have special needs themselves, the potential impact that may have on them. So all of that's built into that tool. We have our one-on-one advice, as Larry mentioned, and then we do have a dedicated customer service team as well. Continuing on to 18, we have implemented Spanish into all of the vast majority of all of our websites. So it's built into our mobile app, it's built into our participant website, it's built in the enrollment tools. So we've really tried to go in and incorporate the ability for folks to be able to see all of their information in their core language. So they have the ability to quickly and easily switch that. If they would prefer to see everything in Spanish, we have that all built and fully functional. We also do actually send out statements. If somebody selects Spanish, we will send Spanish statements instead of English as well. So we do have full capability with that. Continuing on to 19. This tool is really, really interactive and just a nice added feature that we offer to your members. What's nice about it is it does provide that holistic financial guidance, and it focuses on 6 primary pillars that we find helps people to be more confident in their financial future. Whether it's about spending and saving, their retirement, debt, protection, emergency funds, or any other goals that they may have, they can answer a quick series of questions. Based on how they answer that, we actually provide them guidance specific to their individual answers. So it provides a lot of additional resources. It also kind of has a scale that shows them if, hey, maybe this is something you should work on, but these other things are looking green. They're really good. So it provides that additional guidance and resources. kind of wrapping a few of these things up, one of the things that Voya is really proud of is our safe guarantee. And what's nice about that is it's available to any one of your members. They have, as long as they do a couple things. They need to register their account, review their account on a semi-regular basis. Doesn't mean you need to be going in daily, right? But you do need to kind of take a look at it from time to time, whether that's, monthly, quarterly, for example, and immediately notify Voya if they suspect any identity theft or unauthorized activity on their account. By practicing those safe computing habits and keeping an eye on that, we will actually make the individual whole. So if there's any hacking or something that were to happen, now obviously we've got a secure system all on our systems, but if something like that were to happen and they somehow got hacked, Voya will make those individuals whole. So that's something we're very proud of that I like to mention. Last but not least, we do have in here a little bit about our My Retirement Overview program as well. This is available directly on our Voya.com site. They don't even have to be a member to be able to utilize this tool. But what's nice about it is it incorporates a multitude of things. So it looks at the optional retirement plan. It looks at the deferred compensation plan. Looks at any voluntary, say 403B plans that they may have, Social Security, and then any other defined benefit plans that they may have. So we actually have the PERS defined benefit plan built into this program so they can actually demonstrate what it looks like as they continue to progress towards retirement. And hey, is there any gaps? Is there something that they need to do to recognize that and make changes along the way? There's just a really cool program that we do have available to all of your employees as well. So with that, I just want to thank you again so much for taking time to listen to us a little bit about the program. And this time I'd like to open up to any questions.
Any questions?
I have one. Thank you. I want to go to the unnumbered pages at the very back. You have your plan for institutions of higher learning. And in one of the prior presentations, we talked about the 8 institutes of higher learning as well as the medical center, which my math is pretty good. That's 9, 8 plus 1. You list 10 categories on the next page.
Yes, so with respect to that, there are a few individuals in here. So you're looking at the very bottom one, I presume, where it's the Public Employees Retirement System of Mississippi.
That's
that
correct.
Line? Yes.
That's correct.
Yes. So the reason you're seeing a difference in that is if an individual didn't initially identify which school or university they were at, they get put into basically a default number so that we still are taking their contributions and applying everything. So they're still invested, but we just need to update their location specific to the university they're located at.
So those are floating because that might, I'm asking, are those people floating somewhere within the system?
So they're fully invested in their funds. They just don't have a location code, which is why they're not showing up specifically under the individual university. And we've gone through and we've been updating all of that accordingly. So I do actually have updated numbers. I just don't have them with me today.
Okay, but I guess my question is, that's not PERS.
Yeah, no, it's not PERS.
Okay.
Yeah.
But that's 119 people that are currently not identified.
Yeah, and actually I went through and updated them earlier this month. So we actually have updated location codes on those individuals.
They'll fall back into one of the other 9 categories.
Yep,
All right,
yep.
Thank you, appreciate it.
Absolutely. Any other questions?
Thank you all very much.
Thank you so much. Have a wonderful day.
Thank you.
Are there miscellaneous updates for the Defined Contribution Committee? Okay. With no miscellaneous updates, the Defined Contribution Committee stands adjourned.
Are we ready?
Is there we can
Next
move,
step.
the investment committee, you can move straight in, or if you need a break, whichever you prefer.
Ready for this one? Very good. Then I'm gonna declare the investment committee. We're in session then. Charles, I'm gonna turn it over to you.
Yes, sir. Can you hear me okay?
Huh?
All right. All right. Just kind of a quick opening. It's a very short period of time since quarter end, so there's not a whole lot of updates that I have. I do have, in September, the Federal Reserve did cut interest rates by 0.5%. And they also gave signs that there's going to be further easing. China announced significant coordinated stimulus measures, which include fiscal, monetary, and property-related support. Hopefully that fixes China's ills. Global equity markets reached all-time new highs following the Fed rate cut. For the month of September, the PERS portfolio returned 1.61%. And then so far this month, stocks continue to pick up new highs, on record highs that is, on optimism for Q3 earnings. Small cap stocks led, climbing to their highest level since 2021. Tech stocks have rallied last week after chip maker Taiwan Semiconductor's comments about robust demand for AI chips. And then as of close, Friday, the 18th, the PERS portfolio so far for the month is up a whopping 0.03%, but fiscal year to date, a very good start to the year. The portfolio is up approximately 5.11%. Awesome start to a year. And with that, our representatives from Callan are here. Do you have a question?
If I may, so do I remember correctly in August that we was around 10% at that point for the fiscal year?
Approximately, it was a little over 10, yes.
So we're down 5% since that.
Oh, no, 10%? No,
It wasn't 10%.
no, not 10%.
Okay.
Yeah, no, that.
All right.
Yeah, 10% was
Last
fiscal year.
Yeah, no, I was thinking we were up pretty good even within a couple months.
No. We've been up on an average of about maybe 1.4 to 1.5% a month roughly.
Just over optimism or a failing memory or both. Thank you.
With that, I would definitely take that if
Sure.
we could, yeah.
Yeah.
So anyway.
Thank you.
Yeah.
Good morning, Paul. It's a pleasure to be here with you. We're going to go from the white bound book. This is the executive summary. It is labeled preliminary because some indexes we haven't yet received, namely the private equity benchmark index as well as the real estate. But the return numbers, what we have for the assets, should be final. So the economy and it continued to chug along. The long anticipated cut in rates, as Charles alluded to, took place in September by 50 basis points or 0.5%. This was a long time coming. The concern, you may recall, was that there was some angst that the Fed had waited too long. And turns out that they were resilient and did make that change with respect to in the September meeting, cutting it by 50 basis points. We see that, again, equity markets climbing to new highs throughout the quarter. We have a pretty consistent pattern. Some changes in terms of the leadership, as we see that the Russell 2000, which is the small cap index, had a bumper July where it was up 10.2% versus the S&P 500 that was up 1.22 for that particular month. And why that's significant is that we've seen that small cap stocks have trailed large cap stocks for much of the past couple of years. And again, we see a little bit of a leadership change in there. If you turn to page 4, this gives you the highlights. This is the one-page summary of the fund. The assets stood at $35 billion at the end of September, an increase of approximately $1.6 billion. Market value of assets, so the increased by about $1.7 billion, and net flows reduced that by about $117 million. Overall asset allocation was in line with its strategic target allocation. We see that there was a little bit of an underweight to real estate and domestic equity, and those were offset by the other asset classes throughout. During the last year, the fund generated a 19.1% return. That's 18.7 net of fees. The benchmark was up 20.3%. So again, that is the 12-month period ended 9/30. For the quarter, the fund was up 5.1%, and that's pretty much in line with the total fund benchmark at 5.3%. So what added, what detracted? Suffice to say, if we look over the quarter, we see that public equities detracted somewhat. We saw a turn in the real estate markets. We had some more favorable performance there. Real estate being up 2.6%, the benchmark again being negative. Private equity and private credit. Private credit being the newest addition to the portfolio was up about 1.4%, and private equity about 1.4% as well. 1.36 actually, and 1.44. So again, over the trailing 5, 10, and 15-year period, the fund returned 9.3% over the 5-year term, 8.4% over the 10-year term, and 9.2% over the 15-year term. And those are annualized numbers. So any questions on that before we jump into the markets? Okay. Page 5, this is just the categorizations of the broad indices in the market. U.S. equities continue to perform well. The Russell 3000, which is the largest 3,000 U.S. stocks traded in the marketplace, was up about 6.2% over year to date. Again, that's through starting January 1. We see that it was up 20.6%. Global equities rose 8.2% for the quarter, bringing the year-to-date return to about 14%. So again, for this particular quarter, we saw that global and non-U.S. equities outperformed U.S. equities, and that is kind of a sea change. You'll see, when you look at the historical performance, you'll see that the U.S. equities long outperformed our non-U.S. counterparts. Fixed income generated a 5.2% return. That's as measured by the Barclays, the Bloomberg Global Aggregate was also up 5.2%. Trailing the U.S. fixed income because again, the weakening dollar when you take those returns and put them into U.S. dollars, it represented a drag. Private equity declined about 2.3% for the quarter, bringing the year-to-date return to about 1.5%. So that's the private markets property index. Real estate has been the one area, as we know, that has been challenged. So when you look at the taupe bars, you'll see over the last 5-year period, an annualized about 3%, over the last year, down 4.5%. And that's going to be a contrast to when we look at the publicly traded REIT stocks. Those are publicly traded real estate stocks, are more in line with what we would see in the equity markets. The blank table to the left, if you want to enter some of those numbers, the Russell 3000, again, is as of 10/21, that's quarter-to-date return, up another 2%. The MSCI ACWI US, those are your non-US stocks, were down about 0.26. Bloomberg Aggregate, that's your US fixed income, down 1.4%. And the Bloomberg Aggregate, that's global, down about 2.2%. The page 6 is kind of the roster of stocks, but it provides a nice comparative as you look side by side. And what you see here when you look for the quarter, you see that the Russell 2000, that's your small cap index, was up 9.3%. And contrast that with the S&P 500, which is a large cap index, was up 5.9%. And then if you scan over to the right, you can see the 1-year numbers highlighted, and that kind of shows the differential, the strength of the large cap equity market, where the S&P 500 was up 36.35%. Contrast that with the Russell 2000 at 26.76. Non-US stocks, again, what I would highlight here, we see that they outperformed US stocks for the most part. The MSCI World ex-US, it was up about 7.8%. Emerging markets did particularly well, up 8.7%. And the rationale there, the reforms that were announced by China, China represents about 25% of the emerging market index. So goes China, has a big impact on the emerging market index. India also performing well, represents about 14% of that index. When we look for the Bloomberg aggregate, again, this is largely fixed income investment grade index, was up 5.2%, a very robust year to date, 4.4%. Over the last year, it has performed really strongly with an 11.6% return in anticipation of not only the fruition of the cut in rates, but the expectation of the cut in rates. So what we saw in the fixed income markets, you may recall that we had the inverted yield curve where the shorter term fixed income securities were yielding greater than the longer term. We saw some normalization there. The differential between the 2 and the 10-year actually normalized where they were no longer inverted throughout the quarter. So how's the health of the economy? We saw the initial estimate for the third quarter comes in at 2.5%. Inflation is down at 2.44%. That's the CPI. The Fed's preferred inflation benchmark is the PCE. That's the personal consumption expenditure, was at 2.2%. So again, this is down from about 3.3% last year. So the message, the broad strokes are the economy's doing well. We see that inflation, again, the Fed's efforts to tame inflation and maintain high interest rates for a prolonged period of time has been effective. Engineering a soft landing is a really tricky exercise, never really been done successfully. And we're not completely there, but thus far, the strategy has worked out pretty well. And that's really built upon the strength of the consumer continuing to purchase. And what we have is inflation numbers at about 4% are favorable compared to historical standards. So good news from the economy. Nice returns from the fixed income market. As Charles said, the anticipation is that the Fed will cut 1 or 2 more times in the balance of the year, but at a more moderate 25 basis points. Turning to page 7, this is kind of the Callan quilt, if you will. On the left side, we have the calendar year returns, quarterly returns, and then year to date. If you look at the third quarter returns, you see that real estate and the aqua at 16.07. Those are real estate stocks as measured by Nareit. So real estate stocks behave more correlated to U.S. equity stocks. If you scan down, you see in the burnt orange, this is the NCREIF Odyssey. So these are actively managed, open, diversified core equity real estate, private real estate run by a series of companies, 25 or so, the data's collected, and then they strike a median, and that's used for a common benchmark and does contain leverage. So you can see that of the asset classes there, the Odyssey continues to underperform its peers, so it didn't experience the rebound that you saw in some of the equity markets. Fixed income, again, a nice return with the bright green at 5.2%. High yield, which are below investment grade stocks, continue to perform well at 5.3%. And then we have large cap and then small cap stocks outperforming, which is kind of a leadership change. Okay.
I got a question
Yeah.
about that. Over the quarterly returns, the large cap seems to be falling according to this and on our chart here. You know, they're going first to second and then down to fifth. Is there a reason that the other stocks are now outperforming the large stocks, or is that an incorrect way to read this chart? You know, I know what you're doing is tell us, give us the best returns, but
Yeah.
is that more of a normal sort of thing, or is that what we're looking for? And I don't know, I'm asking my question, I'm just saying, is there any trend indicated in this chart?
Yeah.
I'm trying to ask.
I think part of this is a pro-diversification chart in that you've got the leadership changes over quarters, over 1 year periods. So don't put all your eggs in one basket. The idea here is that the leadership, you want to take advantage of that, and having a diversified portfolio makes sense. But with respect to the trends, if you look to the calendar year returns, you see 2019 large cap equity was up 31.5%. And so the dark blue, you can see that that leadership position was certainly amongst the tops. So some reversion in the mean, I guess, is expected. What has been driving large cap stocks is information technology stocks have certainly been driving that. Now we have the Magnificent Seven, which have been driving it. This particular quarter, we had a little bit of a leadership change where smaller caps or the more diversified performed better. But the Magnificent Seven, which is comprised of Alphabet, Meta, which is Facebook, Amazon, Apple, Nvidia, Tesla, those were up a combined 35 year to date. They were up about 35%, and they represented 45% of the S&P 500's return. So the takeaway there was, okay, you had a very concentrated success that was really driving the equity markets in a small group of stocks. What we like to see is a broader diversification in terms of the leadership. So we're kind of welcoming that if the Magnificent Seven can be less impactful and a greater diversification is a healthier metric.
If I might. And what you've also seen in small cap stocks is with the anticipation and with the actual lowering of interest rates, a lot of these smaller companies require or depend on, that is, lower price financing of cash for their cash flows. And so with the anticipation of, borrowing becoming cheaper, that is also added to a little bit of the enthusiasm that you're seeing in these smaller companies. So that, is also a reason for it.
On page 6, if you look at the Russell 2000 compared to the S&P 500, over the last 10 years, you see that the S&P 500 was up 13.4% per annum, and small cap stocks, as measured by the Russell 2000, were up 8.8. And then over 25 years, you see they're kind of in line. Studies have shown that over the very long term, the expectation is your small cap stocks are going to outperform your large cap stocks with greater levels of volatility. And as Charles said, they tend to be more sensitive to the inflation rate and financing because they're smaller companies. They've got a less diversified product line. They're relying on that financing to a greater extent than you might see with a more diversified larger cap company.
Mr. Chairman. Thank you, Mr. Chairman. In a general sense, you listed the returns year-to-date gross of fees. I think you said 18.7 net. Is that correct? And since you've typically outperformed the 5, 10, and 15 year, is there any general attribution to not meeting the benchmark or missing it by 1.6 versus the policy benchmark?
You mean over the short term?
Well, over the last year. I'm just looking at the particular line item.
Sure. So if I'll beg your indulgence, and if we can just jump forward, I think there's a slide that'll address that specific point. If we go to, let's go to asset class performance on page 15. So this slide is providing the asset classes to the left, market values, and then the percent of total of the portfolio. And then we have the quarter, last year, 3 year, and then followed by the next page, 5, 10, and 15 years, okay? And if you, to your question about, okay, so where do you fall short in the last year? You can see your domestic equity was up 32.4% versus the benchmark, which was up 35. So that is, I guess I would check that as a minus, as detracting. We see that global equity was up 30.16 versus 30.96. So that's also down on a relative basis. And international equity was positive, outperforming its benchmark. The fixed income outperforming its benchmark. Real estate outperforming its benchmark. Private equity trailing its benchmark. And cash, let's call it in line. So your 1910 versus 20.33. The biggest detractor is going to be your domestic equity, which represents about 26% of the portfolio. And within that, you have your individual managers there. Let's take a look at Eagle over the last year. On page 20, where we have the individual managers listed. Eagle generated 33% return versus a 36 for its benchmark. And then mid-cap equities at 21.7 versus 29. So mid-cap equities and Eagle detracted. Overall, U.S. equity detracted from return. That would be the attribution.
And then that was kind of the second part of the question, is the private equity side. Do all these numbers represent the new metric and benchmark that the board voted to adopt?
They do, with the exception that we haven't, for this particular quarter, we haven't received the updated benchmark for private equity. So that is basically last quarter's benchmark held over.
Okay, so it could reflect differently when the new benchmark is adopted?
The performance will not, the performance return on the assets will not, the benchmark return, yes.
Just comparatively, it may close that gap a little.
Exactly.
Okay, thank you.
Yeah.
Thank you, Mr. Chairman.
Okay.
Yes, go ahead.
John, how much, if any, of that difference in Eagle there could be Magnificent Seven and they're underweight to those versus the benchmark?
A portion. I think the largest that Eagle would have an allocation, I think their largest position is like 9%. And some of the Microsoft is over, I guess, over its benchmark. It probably would exceed 10%. So there may be some slippage, but they do have some exposure to the Magnificent Seven stocks. They may not be holding the same degree. But what we see from Eagle, so for those that aren't familiar with the allocation, in the large cap equity space, we have essentially indexed the majority of it, with Eagle being the single active manager within the large cap space. And that's because historically they've generated strong returns, albeit, and there will be periods where it trails. But I think if you looked at 2023, I think it outperformed the benchmark by over 10%. So again, it's episodic. We take kind of a long-term view on Eagle, and it does have a difference. Significant difference from the weightings compared to the S&P 500.
And with that shift to index, which has been done in the last 5 years, I think, for PERS, for the fund, for fees, typically, if I remember correctly.
Yes.
Okay.
Yeah.
Is there a relatively large amount of downside risk knowing that it could have been more protected before that with those U.S. equities, with those large cap U.S. equities?
So if I understand your question, in the past, when you had an actively managed portfolio, would it have offered potentially more protection than the indexed fund.
Right. When my funds, which are more indexed than PERS used to be at least, and maybe not as much so anymore, when they were going, they were going.
Yep.
And whenever they dropped, they dropped. And I was envious of PERS's position, which was not dropping near that much as
Right.
my personal assets would have been. Is that any danger there with what's happened in the transition?
I would say that if you looked over the life, let's say the last 10 years of Eagle's performance, 1 year where the markets were significantly negative, it protected pretty significantly. On the other hand, the most recent period, they fully participated in the downturn. So I guess my take is that we look forward to less concentration in the index because the index itself, being highly concentrated in those Magnificent Seven stocks, they're subject to the volatility associated with that, but you get the upside performance as well. So I think given the way that it's sized in the portfolio, we found historically active management in large cap has met with mixed success, not as much as some of the other asset classes. Therefore, we have a greater allocation to indexed assets within the large cap space. So in terms of downside protection, seen it behave both ways, and it depends what's driving the downside performance of the index.
So more importantly would
Yeah.
probably be the overall allocation of the fund and making sure there's not too much heaviness over into U.S. equities and keeping that balanced overall more so than just within that slice.
That's correct.
Okay,
Yes. Yeah.
thank you.
Sure. Any other questions? Okay. Well, in the interest of time, I'll just talk to some of the metrics here and try to provide some guidance. On page 9, let's go to page 9. This is the U.S. equity performance. And suffice to say, what's unusual about this period is that if you look at the blue bars, you'll see the Russell 1000 growth was up 3.2% for the quarter, and the Russell 1000 value was up 9.4%. That is a change that has taken place. Growth stocks, that particular index, the Russell 1000 growth, has got 40% plus technology in it. So technology performs well. If you scan to the bars down the bottom, you see, based on the sector, information technology stocks in the S&P 500 were up 1.6%. The more value-oriented stocks like utilities, real estate were up significantly more. So you saw a change. That's different over the 1 year period, though. If you look to the 1 year number, you see the growth stocks were up 42.2% as measured by the Russell 1000 growth, and the value was Russell 1000 value was 27.8. So that's a 14% differential that you have due to growth outperforming value. So a little bit of a change took place this particular quarter. And again, the other one I would highlight is small cap stocks, which we touched on, up 9.3% as measured by the Russell 2000. Compare that to the S&P 500, 5.9. So, but if you looked over the last year, again, the S&P 500 was up 36, Russell 2000 up 27. So again, change in leadership this past quarter, which is kind of interesting. On page 10, these are your non-US equities. And what I would highlight here is the all-country world index excluding US. That's the third blue bar down. That's a broad metric. It was 8.1% for the quarter and up 25.4% for the 1 year period. So again, non-US equities performing well. A weakening dollar helped those US investors because as those euros, those yen were brought back into dollars, you got a performance bump. The big news here is China, and if you look at that, was up 23.5%. Emerging markets overall was up 8.7. So think China representing 25% of that index really kind of drove the performance. Over the last year, China was up 23.9%. Emerging markets was up 26.1%. So again, China was additive, but there were other countries in that index, particularly India, that performed really well. Turning to fixed income, I guess the highlights here on page 11 would say the nice return coming from the investment grade fixed income markets. The Bloomberg aggregate was up 5.2%. And you'll see that when you look at the Treasury, it was up 4.7, but CMBS, commercial mortgage-backed securities, was up 4.7, mortgage-backed securities up 5.5, and corporate bonds were up 5.7%. So they were additive. In other words, they outperformed their comparable treasuries. As we look over the 1-year period, we see a strong fixed income return at 11.6%. Treasuries were up 9.7, but you see when you look at mortgage-backed securities up 12, commercial mortgage-backed securities up 12, and then investment-grade credit was up 14%. So again, the non-treasury portions of the market did really well in the last year as it rallied. Okay, those are the high-level market comments. Happy to take any questions, and if not, I'll turn it over to Alex to review the portfolio. Thank you.
Great. Good morning, ladies and gentlemen. So we're going to move ahead onto page 13 and take a quick check on the PERS defined benefit plan. This is through the end of September, as mentioned. Although we've marked the report preliminary, we don't expect any of the asset values or returns to change. That really just reflects two of the benchmarks, private equity and real estate, that may be updated as the data comes in. So you can consider this effectively, 99% complete, with only some modest tweaks perhaps down the road. Taking a look at the asset allocation, so this is at the end of September, you'll notice total assets were $35 billion, and staff has done a great job managing the asset allocation as evidenced by that percent difference column. So you'll notice the differences from where you are to where your target says you should be are all very narrow and well within the rebalancing ranges established in your investment policy. And so for equities and fixed income, that's plus or minus 5. For private credit, one of the new asset classes, it's a little narrower. But you can see that the differences are on the magnitude of 1% or less, give or take. So through rebalancing and taking cash out where it makes most sense, staff has managed this effectively. The only other comment we will note is towards the bottom of the table on the left, private credit. That's the newest asset class within PERS. You can see it only has about 0.2% of total assets today, has a long-term target of 2%. That's being built up over time. So you can continue to see more money flowing in there and the asset balance growing as it's built to target. On the next page, we're going to take a quick check on the drivers of change over the quarter. And this is focused on dollar terms, right? We'll take a look at returns in a moment, but just in terms of dollars, where did the growth come from? So if you look at the middle of the page, net new investment, you'll see a lot of red across the asset classes. That's reflecting money being taken out of the investment strategies they're in and repurposed elsewhere, either flowing into cash in anticipation of future benefit payments or being withdrawn from the plan to pay current obligations. And so you'll see at the bottom, the total fund line, net $117 million flowed out of PERS to meet the obligations of the pension system. Moving to the right of that column, the investment return more than compensated for those cash needs in a dramatic fashion. All told, the investment gains on an unrealized basis pushed the market value up $1.7 billion over the course of the third quarter. first quarter of the current fiscal year, so a really strong start. What we like to see, and we haven't seen for some time over the last couple of years, is it spread across all the asset classes. So everything added value in this environment at an aggregate level, right? It wasn't just concentrated in domestic equity or large cap, but across the asset classes, everything was up at a total composite level. So that was great to see. Now, on the next page, we did take a quick look at this, so just a couple of highlights in the interest of time, page 15. We've arrayed the near-term performance across the asset classes. And some changes that we think are encouraging to see. If you look down the last quarter column, in the middle of the page, real estate. Now, it returned 2.6%. Seems, like a lowish return, relatively muted, but when you compare that to the benchmark, it is up on a relative basis almost 3%. That is something we haven't seen in quite a while. Hopefully giving more credence to the idea that that asset class has bottomed and maybe turning the quarter. A lot supporting that we can get into, but that's an encouraging sign. This plays into the idea of diversification, where finally real estate is helping you, whereas the other asset classes above, domestic equity, international, and fixed income, although putting off strong returns in their own right, are really lagging their respective benchmarks in this current time period, in this current environment. That's a change, something we've been monitoring, something that's been a little bit encouraging. And then the last year column, we've talked about this, but that's one of the reasons we review the market environment, right? For U.S. equity, the index concentration that we've talked about has made it really challenging for your active managers to outperform over this short period. Any deviation away from the benchmark, any less you had in NVIDIA counted against you, and it was magnified because of the amount of the returns, right? NVIDIA is up 136% so far this year. So if you had 1% less than the index, it had a meaningful difference. That's not something we expect over the long term, and you don't pay your active managers to look like the index, right? You want them to be a little more diversified, a little more concentrated in their own right. So that kind of explains the attribution why over the last year there's been a bit of a miss. We would still consider these fantastic results. Whether you're a little bit above or below the benchmark, PERS grew at a clip of over 19% over the last year. Benchmark was at 20.3, so fairly close, but regardless, if it was a small miss, still fantastic growth in the assets that PERS has to bear. And then we'll wrap up on page 16 just with a longer term view. Right? Quarter to quarter, even year to year, there's a lot of noise, particularly over the last couple of years. But things start to kind of return to trend when we look at 10 years and 15 years. And over that time period, you'll see the total fund has achieved returns of 8.4% on an annualized basis for 10 years and 9.2% on an annualized basis over 15 years. Really, really strong returns, and importantly, well in excess of the total fund benchmark. So all of the pieces in aggregate, all of the active management employed across the portfolio is doing well, allowing you to do better than what the benchmark says you should have done over those periods. So we think these are great results. We kind of expect this trend to continue, notwithstanding the recent volatility that the pension system has had to navigate. We'll stop there and happy to answer any questions about performance, markets, or anything that pleases the board.
Election results already built into the market.
Election results?
I don't even think the polls know.
Just a quick anecdote on that. Our capital markets team did take a look at history just for the S&P 500, but that's a huge part of the portfolio. Going back, 12 election cycles, when the S&P 500 was positive going into the election, it finished the year positive. And when it was negative, finished the year negative. So the election never really tipped the market either way, agnostic of political party or whatever else was going on. So hopefully that trend continues, because if it does, the S&P is going to march higher regardless of who wins, and we'll have a fantastic year for equities. And that's not our call, but that's what the history has shown, so.
Well, yeah, and when they say the quarterback hadn't had an interception in 7 games, you know what the next play is? Just jinxed it, Alex.
And we'll hold him accountable.
Yeah.
We'll see if I'm back in December.
One more item before we leave this report. I'd like to say thank you. A little over 3 months ago, if you turn to page 24, you'll see under Small Cap International, the Northern Trust International Small Cap Fund. They've been managing money for us now for just a little over 3 months. Now, I understand that 1 quarter doesn't create a trend, but I really appreciate y'all hearing me out on this. This was a very good hire. They returned 10.36%. That was a net number. The only reason that they underperformed the benchmark is because they did have transition lag, meaning that they had a lot of trading that they had to do up front to convert the old portfolio that was being managed by Mondrian to this portfolio. And they did this, and we only paid 11 basis points to get it. We went from paying 60 basis points to 11 basis points. So again, I say thank you for hearing me out and selecting them as a manager to replace Mondrian. So that's all I have.
Do you have anything that we need to do before we break for lunch and then we come back and hear the fixed income manager's presentation?
I don't have anything on agenda for that.
Then I'm going to suggest, board, that we break for lunch and do it 45 minutes, come back at 1 and begin at 1. 45 minutes should give us all time to accomplish what we need to do. Mr. Director.
Sounds good. Sounds good. 1 o'clock.
Okay, we will recess then this committee meeting until 1 p.m. Thank you.
Thank you.